Hello, this is Demon Malone with Compass FX. I hope you're doing well today and you're getting some good trades. I want to continue on the topic of keeping it simple. Keeping your trading simple. Today what I want to talk about is trading away from the weekly open using a trend line and weekly range levels. What you see on the chart is the average daily range pro calculator from Compass FX. It automatically plots the weekly range levels from the start of the week. So as the market opens up, these levels are plotted and they stay the same for the entire week. So if the market is trending up, you already have a target in mind. If the market's trending down, you already have a target in mind. If the market's even moving sideways, not really going anywhere, you have some targets like the weekly mid-high and the weekly mid-low. As a matter of fact, what you see here on the chart is the weekly high, mid-high, the weekly mid-low, and the weekly low. These make up the primary range of the week based upon the previous week's movement in the marketplace. Now I've added the weekly open so we can identify where that's at, and you can see that the average daily range pro calculator also plots 3 extensions up and 3 extensions below the range of the market. Now if you're interested in the average daily range pro calculator and you want to learn more, simply go to www.compassfx.com/ADR and you can learn more about the average daily range pro calculator. So here's what we're going to do. We're simply going to let the market get started, and from the open of the week we're going to be looking for either lower highs or higher lows, and we're going to draw a trend line. We're going to trade away from the trend line and trade away from the weekly open. And then our target is going to be a weekly range level. If that level's broken, then we're trading on to the next target, which would be the next weekly range level. So let's take a look at what's taking place here in the euro dollar this week. So from the open, I simply wait for a while for the market to get going, and then I see a lower high. Let me zoom in a bit here so you can see this. So you can see that I've got this lower high, and you can see at this point I'm looking to trade the market. And it comes back, it tests the weekly open, I've got a trend line, and so right in this area I'm trading short now. And I'm looking for the market to move to my weekly range level, the mid-low level. The market comes through it, and the market doesn't necessarily come back to it, it just continues. So this is an opportunity to continue into the trade using maybe a trailing stop all the way down to the weekly low level. Now the market sits here. Now oftentimes we look for the market when it kind of sits at a level to retrace. Sometimes it does. If it retraces, we exit the trade, we look for the market to move back to the trend line, and then we look for a bounce off the trend line and then to trade away from the trend line, again trading away from the weekly open to the next weekly range level. Now one way to determine if the trend is getting stronger in that direction is to look for continual lower highs. In this case you can see here from that high we have a lower high right there. So the trend is actually getting stronger to the downside. So we can continue in our downward pursuit and look for the market to move from level to level to level. There's going to come a time though where the market is going to hit, like here's a high right there, and if I put on another trend line, eventually what the market's going to do is the market's going to walk the trend line down and it's going to cross over and then test it. And that's where we're looking to exit the trade if we haven't already come out of the trade. And the market did bounce around. Now it did make a higher low at this point, so in this case I could have moved my trend line down this point here, okay, and then waited for a test of that trend line and then again traded away from the trend line. Give you another example of this. You can see that the dollar CAD started out the week, now it moved down away from the open of the week, but then it started moving back towards the weekly open. Now again, I'm not trading towards the weekly open, I'm looking to trade away from the weekly open. So I'm not looking to make this trade here. I'm waiting for it to get above here. Now let's say for instance I took the trade here, where's my stop loss? Typically I put that stop loss below, in this case, below the previous weekly range. Now in trading the euro, if I'm trading here, I'm going to put my stop loss above that previous weekly range, in this case the weekly open. So in this case, as the market breaks here, I put my stop loss up underneath here, and that's about a 25 pip stop loss. Now that might be too much for some of you, and that's okay. You could put it under a swing low, one of these low points here if you want. If you notice, you can see that I've placed a higher trend line, and the market came down and bounced and moved away. So really what we're looking for is to trade away from the open. So in this case, let's say we're in this area right here. We've held the open and we trade away. So we trade to a level. The market continues. We trade to the next level. And again, we could step out of the trade at a level, scale out if we want, use a trailing stop, whatever is most convenient for you. If the market continues making a move to the upside, then place your stop loss underneath that previous low, and then look for it to move to that next weekly range level. Here's another example, the Kiwi dollar. You can see that it went from that high to that high. Now again, here's an example where here's the weekly open, pushed away from the open in that period of time and went down the hour. But in this case, I'm looking to trade away from the open, so looking to put a trade on here. Notice how the market came back, tested that trend line, and we're trading away from it. We placed our stop up above. Our targets are going to be here, that level, and this level on down. Now this came all the way down, almost hit that level, and then started to retrace. In this case, you can have a tight trailing stop, step out of the trade, the market pulls back towards the trend line. We're looking to trade away from the trend line into the next weekly level. And again, it kind of continues, and we could again place the another trend line down lower like so. And then when this one formed and dropped, we can place another trend line if you're looking at doing that, because oftentimes the market will move these trend lines. And you can see here how the market had pushed back to the first extension low after coming down right to the second extension low level, came back, and it tested almost this trend line and then made its drop back down. And there's the Aussie Kiwi. This happens on all the pairs coming back and testing trend lines. So you can use it on the minor crosses, you can use it on the majors, you can use it on any of the other major currency pair crosses. But we always look for the market to test the trend line, coming back and bouncing, and then taking the trade away from the weekly open and away from the trend line. And that's how this simple technique works. Wait for the market to get going, show either higher lows or lower highs, place your trend line, look for that trade set up away from the trend line, away from the weekly open, and you already have your target in mind using the weekly range levels. If you want to, again, take a look at the average daily range pro calculator at Compass FX, go to www.compassfx.com/ADR. I hope this technique will help you in your trading. Y'all make it a great day. Get some good trades. We'll talk to you next time. Bye-bye.